In the fast-paced world of business, finding a clear path to profitability can be a challenge. Welcome to 0 to 100 with your host, Jared Guy Randolph, seasoned business and finance expert. Tune in for actionable insights and strategies to accelerate your business success.
Hello, Accelerators. Today on our episode of 0 to 100, I am privileged to introduce our guest, KC Chohan, who is the founder of Together CFO, a CFO accounting and bookkeeping service who works with high net worth individuals with tax strategies and helping them protect their wealth as well as their assets. KC is also a professional speaker, a writer for Forbes magazine, and has been featured on everything from Yahoo Finance to NBC to Fox News. Some of the topics we will cover today are the strategies and tips that high net worth individuals use to avoid paying taxes that you can use as well, using your home as a tax-free profit center, employing your family, i.e. your children, as well as long-term wealth, tax, and growth strategies. For those of you who do not know me, my name is Jared Guy Randolph. I am the founder of BoxFi. We are the nation's leading payment consultant. Our talking points today are the strategies that high net worth individuals use to reduce or eliminate their taxes that you can employ as well, setting up a family foundation, employing your family members, i.e. your children, as well as using your home as a tax-free profit center. For those of you who do not know me, my name is Jared Guy Randolph. I am the founder of BoxFi, the nation's leading payment consultant, providing business growth solutions through payment processing. And I'm excited to share the network and community that I've built over my 25-year entrepreneurial journey to help you grow your business and become more profitable. Ladies and gentlemen, let's accelerate together. KC Chohan, how you doing?
Fantastic. Thank you. And yourself?
I'm doing amazing. I want to thank you for joining us on 0 to 100. And we've got a live one today because we're going to talk about tax strategies, and we're going to talk about them from the standpoint of high net worth individuals, the secrets that they use and how that can apply to our audience of business owners. So Casey, before we dive in, I have a question for you. Is there a saying or a mantra that you have that you find yourself repeating every time you're talking to one of your clients?
Yeah, absolutely. It's make more so you can give more. Because when we look at all these elite billionaires and families, they're also philanthropic when they say they're going to donate 99% of their wealth, when there's a lot more at play there. But definitely all comes in. It's not how much you make on the top line, but it's how much you keep it on the bottom line is the key number. People often get mesmerized by the top line vanity number and they don't really talk about the bottom line take home. So we want to flip that script and we want to help people take more home when all is said and done, rather than looking at big vanity revenue numbers.
So how do you actually balance that and toe the line between being somebody who is giving to the community and philanthropic and somebody who is also looking to make money at the same time? Where is the balance?
So we call it strategic giving, and that is you are doing something to better your community or support a cause that you're passionate about, but you're also getting the benefits of the tax deductions, the asset protection, the legacy creation, the elimination of capital gains tax along the way, which most people don't realize that if they enter this world of tax exempt, that there's a lot of additional benefits other than just the feel good factor of contributing to your local charity.
That makes sense. So you work with a lot of high net worths and you build these tax strategies that are very beneficial to them. Walk us through what makes what you do very unique in the industry.
Well, we're a hybrid. So yes, we work with family offices all the way down to doctors and people that are making a lot of money.
Mm-hmm.
But comparatively speaking, we're a hybrid because usually to get into these structures, you need to be at a high net worth level, 20, 50 million plus. And what we've done is we've broken off one segment of that puzzle piece and made it more attainable for the regular millionaires, which, you know, every single day there's more and more of them, but they don't have the team around them with the strategies of the elite. And that's the gap that we've tried to bridge.
Okay. So you mentioned the team. Talk to me, if you are a high net worth individual or a high income earner, what your team actually needs to look like to make sure that you have everything in place to be as efficient as you possibly can with your earned capital.
So yeah, so when we're starting out in business or in your career, you're not really going to be in a very complex situation. You're either going to have your own business or you're going to have a W-2 income. It's pretty easy for most professionals to be able to help you get your taxes filed and away you go. But as you accumulate wealth and you go from being a business owner into a high net worth person who has a lot of assets, then it becomes a lot more complex, right? So then more loopholes start to apply to your situation, whether you become a real estate investor or whether you have kids and you get additional write-offs, and a lot of additional things can happen. But then when you get to a certain wealth level, all of that really isn't enough, and you need the next level of advanced strategy and structure. And that's really where we come in, where you have amazing strategic individuals around you in all avenues, from accounting, strategic giving, insurance, real estate. So this is your dream team that you're building. If you think about it, like maybe the dream team in a basketball setting where they pick the best players and they all play against the rest of the world and what have you, you're handpicking these advisors to work for you or your family. And if you think of an analogy where you have a CPA that has thousands of clients, so come tax time, that person's going to be inundated with the same requests. Hey, what the financials? What's the taxes like? But imagine if that one CPA only had one client or one family as their client, how much more attention that one individual would give to that client in order to over-service them, get them the most efficient tax-saving strategies, because he'll have more time to devote to that client, to research, to get what is available, if he's good enough, of course, assuming he is, compared to if he's got thousands of clients constantly ringing him at tax time, extension time, and he's not incentivized to really save you money at that point. He's incentivized to get a tax return filed, which is the main difference that most people don't understand. So at a family office level, the individuals or the professionals are working just for you and your family and dedicated to just you and your family, which obviously has a bigger cost, right? So if that CPA makes, let's just say, argument's sake, $1 million a year in his practice, why would he go work for a family office if he isn't making that much or more? So you can then see why it's so expensive to have a family office. If you've got 5 or 10 of these advisors that are all really good in their individual specific fields, it could cost you $5 to $10 million a year just to run a family office, which if you're not in the high net worth, it doesn't really make sense for a lot of people.
So let's lean into family office a bit. Walk me through, so our audience are business owners and entrepreneurs, and many of them have had successful businesses that they have exited or successful businesses that they're looking to exit. When do you get to the level where you should be looking at, number one, having your own family office, or second option, being part of a multifamily office so you're getting that more hands-on attention?
Yeah, I think the barriers are changing all the time as things are becoming more virtual and online and things of that nature. So traditionally, you would have a family office. There wasn't such thing as a multifamily office. Then there became a multifamily office where now there's maybe a few families that are serviced by this group of people. Now there's virtual multifamily offices. So now you can do the same thing in a virtual setting, just like we're doing here. So again, the costs come down again. So where it used to be in the 25, 50 plus million range, anyone with a net worth of probably 5 plus could start looking at either building their own dream team and having like a virtual family office, or going into a virtual family office and seeing if the fee structure makes sense for the amount of benefit that they would get.
Also, one of the things that I'll say about family office, because I've been around the family office world for about a decade now, and funnily enough, I actually I'm working on organizing a family office dinner in December based on the usage of or implementation of AI with some very big family offices in New York. The family office network becomes the ultimate benefit to you because you're around other wealthy people. You get co-investment opportunities. You get a look behind the scenes of what those elite investors are investing in. And those relationships are really what can take your portfolio and your net worth to the next level because you can all invest in some of the same things. So I didn't know that 5 million was the barrier to entry or a thought of barrier of entry in today's world, because I was always under the impression it needed to be at least 25 million, if not more. But if you can get into a family office, the relationships hands down that or multifamily office, there really could catapult your net worth.
Yeah, 100%. And again, your net worth is your network, right? Because you're in these rooms, you come across different deals of all sizes that if you weren't in that room, you would never even know you had an opportunity to get into at an early stage. So it's definitely worth being the smallest fish in the biggest pond, right? Rather than the big fish in the small pond.
Yep. And you go into it with open arms and ready to learn. And you'll find that a lot of people within those networks are willing to give more information to people and help and teach you what they know and how they have built and amassed their wealth because they have a lot of respect for you for getting there. Yeah, especially if 100%. You're the $5 million range, most people are earning that themselves. And I know that at Together CFO, what you guys really do is you focus on that relationship building. You focus on getting that person's net worth to the next level through the strategies and the structures that you implement. And one thing I'd love to talk about is what is the difference between creating really good structures for your net worth versus just looking for loopholes in the tax system?
Great question. So simple answer, everybody should be using loopholes along the way. So if you think of, there's so many loopholes and they're very easily accessible. We even did the top 50 loopholes that everyone should be using. We'll send you the link so all the listeners can click it and get it completely free. And it's a real simple test. You can download that, send it an email to your CPA and ask him or her, how many of these 50 are we using? And if the answer comes back and you're not using as many as you should be, you can instantly know that you've been overpaying on taxes. Now, as you start, sorry, go ahead.
No. You keep going. I got 2 questions. This is really good. Okay. Go.
So that's one. Do you know how good your CPA team is? And how do you know that? Have you been ranking them? Are you comparing them? This is a simple way, an exercise by sending one email to kind of see how well they're doing, like a scorecard in school, right? The second thing is, the higher up the net worth ladder you go, the less relevant loopholes become because they just simply run out. Let's use a car as an example. You can buy a car and depreciate it and write it off, or you could buy some real estate and do the same, but you need to have the cash flow to do it and sustain the asset. You might just need one car. You're not likely going to need a fleet of 10 cars. So how much can you use that loophole? You can write off a kid deduction. You can hire the kids, child deductions. You can rent your home back to yourself for 2 weeks. But again, you get to a certain level of wealth and that's not enough, right? So these tens or hundreds of thousands of deductions, still you've got millions of dollars of net profit left over. You're going to have a huge tax bill. So loopholes are maybe, let's call it step 1 in the value ladder of what everybody should be doing, because mostly free to do unless you have to do a small survey, conservation easement or something along those lines, right? But generally speaking, free or low cost. But then when you're still paying multiple 6-7 figures in taxes, you need something more robust. You need a structure. And it's like building a house. If you build a house on sand, the likelihood is it's not going to settle well. There's going to be cracks. It's going to fall down at some point. But if you build a solid foundation, then on that structure, you could build a house, you could build a condo building, you could build a shopping center, a hospital, whatever you want if you have the right foundation that you're building on. And that is really having the right structure in place. So with the private foundations and the tax-exempt world, that's one piece of a wider structure. in the estate plan for a few different reasons, 4 main reasons. One, for creating lasting legacy, asset protection, tax savings, and totally eliminate capital gains.
Okay, so I want to come back to the private foundations and eliminating capital gains, and we're going to talk about what your numbers need to look like for you to be able to get there. But back to the loopholes. So there are the common loopholes that everyone hears about on YouTube and Instagram, and they've got every tax expert out there giving you the basics. What are 2 to 3 loopholes that most people are unaware of and most of their accountants are unaware of that they're not implementing?
2 unusual ones. The Augusta loophole. I don't think many accountants even do that. And that's a really simple one. It's just to rent the house back to yourself for 2 weeks. Pretty simple and easy to do that. And then employing your kids. I don't know how many people are actually employing their kids, whether that's on social media postings or as a model on their profiles, or if they're older, they could do research or cleaning of the office and things of that nature. So depending on the age of the kid, as young as 1, they could be modeling and kind of using their presence on social media, and they get 13-ish thousand a year tax-free. And what we'd recommend is if the kid is doing something to promote the business, they're getting paid, and then that tax-free money that they have earned could go towards paying for their schooling or the nannies or the other type of non-tax deductible expenses that you have.
So I've got a question for you. Let's say you've got a real estate agent and they've got a 2-year-old. How would they effectively use their 2-year-old in their marketing to be able to write that $13,000 off?
Oh, it'd be really easy. You would just have the 2-year-old in the house while you're videoing it and saying, look, this could be a perfect family home for you and your family. And it's really easy to paint that vision of how me and my 2-year-old are walking this multi-million-dollar house, and you could do that same thing too with your kids.
So we're having dinner with friends tomorrow night, and they have a 2-year-old, and he's in real estate, and they have a nanny, and I'm 100% telling Sean that he needs to be doing this because his little kid is freaking Hudson's so cute. He should absolutely be in the ads. They already look like models as a family. So I love that idea, and that's a really good takeaway. So if you're a restaurant, it could be your kid in your ads for your restaurant. If you are a construction,
they should be eating the food in the restaurant, getting it all over their face, right?
I mean, that's probably enough that we can just end it right now. That is the best, some of the best information we've gotten, and the clarity on how to do it is really important. And little things like employing your kids. Some people, or we've heard of it, we're just not sure how to do it properly. Let's talk about the Augusta Rule. And you had mentioned being able to rent your home back from yourself for 2 weeks a year. Talk us through how that works.
So you would just take the fair market value of the home. So you could get that by looking at comparatives on Airbnb, or if there's a similar home that's up for rent in your community, or realtor friend can kind of give you an estimate. And then you can do a corporate retreat in that home for 2 weeks.
So it would be the daily rate, and then you're renting the home from yourself. Are you saying that's a write-off?
You get a tax deduction for that, yeah.
Okay. So let's talk this through. Let's say we've got, you know what? We're going to go all out. We've got a home on the ocean in the Hamptons. And we could, and the Augusta Rule is literally from Augusta, Georgia. I know that this stems from people who are renting their homes during the tournament, that you throw events. You do 14 days out of the year and you have 14 different events. Are you saying that your company is renting the home from you, or are you actually renting it out to someone else?
Yeah, so there's like a 14-day limit, right? And then the LLC can pay the homeowner rent for up to 14 days per year.
So if the daily rate for your home, and with looking at comparables of Airbnb, is $1,000, you could technically get $14,000 in income from your home. And you're saying, just to be clear, you can write that off under the Augusta Rule?
Yeah, and then just to give you the next level of detail, the homeowner doesn't have to report the rental income on their tax returns because it's under the threshold, whilst the LLC gets that as a tax deductible rental expense. provided
Okay.
obviously it is a legitimate business expense, right?
Okay.
They're
Now
assuming that.
now I understand because I've heard scuttlebutt about people doing this, where if they do have a big home in the Hamptons, that if they were to compare it to a catering hall or a venue that they'd have to rent, it's literally $20,000 a day to rent something where they've got a 10,000 square foot home and can accommodate 300 people.
Yeah, because if you look at weddings as a prime example of that, right? If you host a wedding at that beautiful house in the Hamptons that you have, and it could be hundreds of thousands of dollars.
Wow. And that comes in as income that you don't have to report. I just want to
Only
make
for
sure
14 days. That's the key
for 14
threshold,
days,
right?
So you could literally make $100,000 a day over 14 days, which is $1.4 million, not have to report.
Gotta have a couple of $1 million home to be doing that, but yes.
Yeah, I mean, that's why we're literally focusing on the homes in the Hamptons. My house in upstate New York is not getting that.
Yeah,
but that's actually pretty cool.
Applies. Yeah, the
Right.
same applies. Is that is something that everybody should be doing. You're already thinking, if you're a business owner, you don't ever stop thinking about your business. So why not do a retreat at your own home?
But that makes sense because you could own a hair salon and you could do offsites at your home, and your company rents your LLC, your hair salon rents your home from yourself.
Yeah.
Wow.
And it's good to actually get out of the office for that environment. We follow EOS principles, and that we always do an offsite and always get out of the office. As nice and comfortable as the office is, just having that different energy, that different environment is useful.
Are there any of the tax loopholes that, let's say your accountant has not been applying them, but for the last 2 years, they applied to your business? Can you refile your taxes and recapture those tax loopholes? Or are they only moving forward? They're not looking
you
in
can
the
go
past?
back 3 years. I believe 3 years. You can go back and redo that. But you'd have to calculate to see how much if it's worth doing it or not, because the cost of then refiling however many different returns you have, a business return, a personal return, kids, is it worth the saving that would be involved? You'd have to do that math. But let's say if you downloaded the top 50 loopholes and there's 20 of them that you haven't used, likelihood is there's tens of thousands of dollars that you've overpaid that you didn't have to.
Got you. Understood. So talk to me about setting up a foundation. And I want to go through each 4 of those categories that are the benefiting elements of setting up a foundation. And let's end on that topic, talking about how you avoid your capital gains.
Yeah. So it's quite a complex process to get the foundation, right? Because
and let me interrupt you really quick, because I want the audience to hear this going into. Where do you need to be financially for it to make sense to set up a foundation?
If your tax liability, if you're paying in taxes over $500,000 a year, it's a no-brainer.
Okay.
If you're getting close to that, you should at least educate yourself and learn about it. Maybe 300-400, it starts making sense. But at 500, it's a home run. You need this.
Okay. Got you.
And that's not revenue. That's not profit. That's taxes paid, right? Because the others can be so variable based on which state you live in, based on what your deductions are, based on what your revenue is. So if you pay over $500,000 in taxes and you want to reduce that, look into a private foundation.
And let's call it what it is. If you have a $500,000 tax liability or tax bill at the end of the year, God bless you. You've got a profitable business. So now let's talk about ways in which you circumvent having to give all that to the government.
Well, yeah, there's many ways to do it. This is just one of them. So again, I'm not saying this is the perfect solution for everyone. You have to have certain requirements. Obviously, the taxes are a big driver of this, but not the only driver. You have to have excess capital as well, because if you need all of the money that your business generates personally, then philanthropy is not really there yet, right? You need to have excess capital to put into the foundation for this to make sense. So again, you might be making a lot of money, but if you're spending a lot personally, if you've got that house in the Hamptons and you've got $100,000 a month mortgage on it,
Mm-hmm.
you have a really high overhead as well, right? So you got to take that into account. It's not just how much you make, it's how much excess capital you have after personal expenses, because 30% of your AGI, your adjusted gross income, or net profit is closest thing that most people would understand, can be donated into a private foundation.
Okay, so let's talk through the steps of this. You're doing over 500. You have over your tax bill's over $500,000. You've got that excess capital. Now, when you go to set up this foundation, how do the numbers work? How does the money flow?
So your business, let's assume that it's you, right? You own your business 100%. So if it makes $10 million in net profit, that $10 million comes straight to you and you pay the tax on that. It's in the worst tax bucket because it's ordinary income. It's actively earned. So you could be paying 40, 50% tax rate on that, depending on which state you live in. If you're in Florida or Nevada, it might be a little lower, or Texas, but I'm in California, so it's higher here, right? So let's just say on that 10 million, you're going to pay 50%. Let's go easy on the math for ourselves.
Cool.
So 5 million of that is going to Uncle Sam straight off the top, and you're left with 5 million profit to go live your life and have your wonderful lifestyle with. But what if you had a private foundation? The private foundation can take a 30% donation. So of that 10 million, you can donate 3 million into the private foundation, and that lowers your taxable rate from 10 million down to 7. So if we just use that first part of the equation, now your tax bill has gone 50% of 7 million would be 3.5 million. So just by doing that one move of the 3 million into the foundation, you've saved 1.5 million personally on your tax bill. Sound good so far?
Mm-hmm.
The kicker is the 3 million is still sat in the foundation that you fully control. So now with that one move, the total wealth created is the 3 million plus the 1.5. So 4.5 million has now been created for you to reinvest however you wish.
Okay, so this makes sense. So if it was $500,000 and you had 250, but you could take out 30%, that's $150,000 that you could put into your private foundation, and then you've got 350,000 which are going to be taxed on above and beyond that. So you've got $175,000 that you're saving in taxes. So combined, it's $225,000 that you're saving. I think that's math is right. Excuse me, it would be $325,000. That is a huge saving. So let's say you've got that savings of the $175,000, and then of the $500,000, you've got the $150,000 in the foundation, or for your example, the $3 million in the foundation. What can you do with that money that's in the foundation?
So, beautiful question. This is really where all the special stuff comes in, because now you're playing in a tax-exempt world over here compared to chasing tax deductions over here. It's completely different, night and day different. In the tax-exempt world, you can invest the same way that you would personally in stocks, in bonds, in real estate, gold, crypto, pretty much whatever you want, as long as it isn't too risky. Like, let's use penny stocks as an example. That would probably be too much of a risky thing to bet on, rather than an ETF of the S&P 500, right? It's very safe and secure, or a treasury bond. So as long as it's not too risky, you can invest in pretty much anything you want.
Gotcha. And then the income that you get from that investment, what can you do with it? Because I'm assuming you can't like pay for your personal expenses or to like go to the movies and use your foundation credit card. What can you do with it once you're starting to generate income on it? And can you take any of that 3 million out to pay certain expenses?
Yeah, great question. And this is, we get this every single day. So you cannot, they call it self-dealing. So you cannot take the money out the foundation to better yourself, because you're classed as a disqualified person. So a disqualified person is someone who's either donated in or is managing or affiliated with the foundation. So it'd be you, your wife, your kids. But siblings are okay, because if you've got a brother or sister, it doesn't mean that they are part of that foundation, right? Secondly, you cannot go to the movies and have the foundation pay for it because that's personal gain, right? So anything to do with your personal lifestyle, i.e. your home, your grocery bills, things of that nature, should not be expensed through the foundation. That's on you personally from the money that you make. No way around that. But there is a way to get money out of the foundation. And that is just by taking a salary. If it really comes down to it, again, this is just for wealth accumulation, right? When this is excess capital that you shouldn't really need personally. But if you did, for whatever reason, you can always take a salary from the foundation.
Could you go out and buy a home as a corporate retreat for the foundation? Could you also, when you're not using it as a corporate retreat for the foundation, can you Airbnb that home?
Yeah, 100%, because that's an investment, right, that the foundation has made. And you can definitely do that. That's not a problem.
And then the foundation can pay all the expenses for the management of that home. Now you're getting income if you're Airbnb-ing it, but everything can be paid to the foundation. Could you buy a private jet with the foundation's money?
As long as it's used for foundation purposes. Yeah. Jets, yachts, cars.
Foundation purposes. What does that mean? Does that mean I need to be donating to the ASPCA and we're, flying people to an ASPCA fundraising retreat? Explain to me what it means to be doing the right thing by the foundation.
So it all boils down to the foundation's mission and purpose. If you are promoting the foundation or doing an activity that's going to benefit the foundation, that is then all foundation work. So as an entrepreneur, I would argue most of your time, and I know most of my time, I'm always talking about business or doing something related to my business.
Yeah, ad nauseum.
There's very rarely a conversation I have where no business is talked about at all, other than maybe sports, right, on a Sunday. Yeah. It's the same about the foundation. What's the mission? What's the purpose? Are you trying to help underprivileged children in Africa or education in your local community? Or is it a Boys and Girl Scouts type thing? Whatever your mission is, and again, this can be broad. It doesn't have to be so pinpoint specific. If it's education, science, research, there's no right or wrong. As long as you are talking about promoting or doing something that even that you may want to donate into. So if you wanted to go to, let's say you're a Christian and you're going to Rome, to the Vatican, you may want to donate to the Vatican, right? So you want to go check it out. You want to go meet them, see if it's the right place for you to be helping. So all of that type of research can be done as well.
So you can do R&D through your foundation.
It wouldn't call it R&D in a tax-exempt world, but yeah, effectively you are researching, or you're checking to make sure that the places that you're looking to fund or issue a grant to, or not that you have to do any of that, but you have the option to, right? So if you go into Rome, it'd be rude not to pop into the Vatican and just say, hey, I'd like to make a donation. Can you run me through how you're going to use these funds, or how you currently use your funds? What's the process? Because you may not align with it, right?
So let's say that we've got $3 million in our fund and we want to give money to AmFAR. Can we pay for our gala trip to the south of France every year through our foundation if we're giving to AmFAR?
So yeah, we're going to be careful on that one. So the foundation...
I know. Listen, I'm stretching the limits here. I'm just trying to find out what we can and can't do.
Yeah. So the foundation can't pay, or shouldn't really pay, for you to attend another gala, even if it is held by another nonprofit. But you can attend that. And if you wanted to donate something, you could become a sponsor. There's other ways around doing that. Or if you happen to have your board meeting there at the same time, then you could host your board meeting there and just attend the event personally.
So there's no restrictions around where you could have a board meeting. I could have a board meeting on a yacht in the middle of the Mediterranean.
It's totally up to you. Yeah, you're in control of that entity.
I'm trying to set us up here and all of the audience so we can live an amazing life and figure out how to do it the right way with the tax loopholes that are out there. Can you share a story of someone that you've worked with recently where you've been able to create significant tax savings for them?
Yeah, like the whole reason or story that I ended up in this world wasn't initially because I wanted to figure out the whole tax situation. It was when I started my own business and we were doing CFO services. We had a really big success with a client where we took him from 5 million a year to 120 million a year.
Wow.
And that created a huge tax problem for him. And he then pretty much forced me into figuring it out, even though I didn't know anything about taxes. But I can read, I can research, I can ask right questions. And the commonality that I saw was that all of these elite families and billionaires have this specific type of private, non-operating family foundation, which is very different to a private operating foundation, which solicits donations. These entities do not solicit donations. So it's a small word, non-operating versus operating, but it means a really big difference.
So the non-operating, are they actually donating from the foundation to their mission? Are they actually writing a check?
You can, yeah. So your foundation has, it's called the 5% expenditure rule. Let's say you have $3 million of cash sat in your foundation year one. The 5% expenditure rule says you have to expend at least 5%. So in this case, it'd be 150,000. And that can be either on donations, grants, or overhead. So you can allocate between all three, or if it goes all on overhead, if you pay yourself a salary, travel, board meetings, things like that. The admin of having the foundation, it's not free, right? So you can cover that.
Wow. Well, we just learned a ton about foundations, and I'm ready, willing, and able soon. Let's talk a little bit more about asset protection and what you need to implement for long-term wealth creation.
So great question. In America, it's probably the most litigious place in the world. I think we can all agree on that one. The higher up in wealth you go, usually the more assets you accumulate, and therefore the bigger the target on your die. We get this all the time, specifically with our medical doctor clients. We got a practice, turns into 2 practices, turns into 5 practices, and every other week they're getting sued by someone for some reason or probably no reason at all, right? Just because people know that they've got a target on the back, they've got some money. But if the assets that they owned were not in their name and they were owned in a tax-exempt entity, there's a couple of big benefits. One is if you did get into any legal disputes and someone did an asset search on you, nothing would come back because you don't own anything. It would be in the foundation's name. The second benefit is those assets owned by the foundation grow with zero capital gains tax. So let's say you bought a piece of real estate for $1 million, and then a few years later it was worth $5 million, and you wanted to exit it. You would have paid the net income tax along the way, which is 1.39%, 1.4%. But on the exit of that $5 million, you wouldn't have to pay any capital gains tax.
What do you mean by the exit of that $5 million?
So you bought the asset for 1, and then a few years later, you're selling it for 5. If that was you personally, you'd pay capital gains tax on the 4 million different, maybe 30%, maybe 35%, depending on where you live. But in the foundation, you would pay 0 capital gains tax.
But that 4 million profit has to go back into the foundation.
It would always be in the foundation because the asset was owned by the foundation.
Okay. And you say don't own anything in your own name, own it in the foundation. Can your primary residence be owned by the foundation and you rent it from the foundation?
No, it shouldn't, because you'd be self-dealing and you're a disqualified person. So that's like you're getting right on the line there where you shouldn't do that. And, there's probably things that you could do if you really wanted to push the needle and have a home office of the foundation in your home. But it's really not worth pushing it that far because, like I said, it takes a lot to create these entities and get a letter from the IRS saying this is a tax-exempt entity. And then you've got to jump through a lot of hoops to make sure you stay in compliance. with all of the rules, because the worst thing that could happen is you spending all this money to create this structure and you're now compliant, and then you fall out of compliance because it's difficult to get that determination letter back.
So what is the complexity to get that determination letter? What is the process? Let's say we've got one of our listeners who has a $1 million tax bill every single year, and they now want to set up a foundation. From listening to your brilliance, what is the process they have to go through to set it up?
Just reach out to us and we'll do it all for you. But
so you make it that simple.
we offer a white glove service because there is a lot of steps. So you got to go to the state. You got to file with the state, get their approval first. Then you go to the feds, and then you file a different type of exemption with them. You got to show them all your documentation, make sure it's all signed and certified. And then they can take anywhere from 4 weeks to 4 months to get a decision back to you, at which point you then need to go open specific type of nonprofit bank accounts. And again, the same with wealth accounts. If you have like a Schwab or a trading account, and they want all the documentation too. So there's a lot of T's and C's involved in making sure you do all that properly, because a lot of people just throw in the first thing they see and they don't get the determination letter. It gets rejected. The vast majority of them do get rejected because they don't know what they're doing, right? It's like, it's the whole reason you employ professionals that have been there and done that, so you can fast track it. And then once, let's just fast forward, say you are successful and you've got your determination letter, you then have to register in a few different places as well to make sure that you get the full benefit of having a foundation. Once that's in place, it's a compliance game, because you've got to make sure you're having your board meetings regularly. The meeting minutes have to be to a certain standard. You have to be aligned with your mission. And then there's no self-dealing to disqualified people. So you've got to make sure that if you are buying that vacation home, that you've got a management company in place, that everything is above board and it's working well, because you can't make any crazy investments. So let's say you have a wealth manager, you'd bring him in, open the wealth accounts and manage that, and make sure that you do stay in compliance, because come year end, it's not just a simple 1040 tax return. This is a 990 PF and it's 50 to 100 pages long. And not many CPAs know how to do it either. They can probably struggle along and try and figure it out, versus going to a firm that just focuses on that one thing. You're going to get a much better service. So it's generalist versus specialist is really what you're looking at. Thankfully, we do it all. So we're a white glove service from creation of the foundation, figuring out what your mission, your purpose, and all the rest of that good stuff is. And then making sure you get the letter and the approval. And then more importantly, you stay compliant and that you're doing the bookkeeping correctly. We'll obviously do that for you. You review it, and then we do the tax filing too. So it's a one-stop shop for everything related to strategic giving in non-operating private foundations.
Well, for the holidays that are fast approaching, I wish everyone a foundation, because it means that you are doing pretty darn well in your business and in your life. Can you give us some trends or things that you see forthcoming in terms of legislation that would have impact on our audience of business owners?
Yeah, well, the biggest one probably for your audience is that the estate tax threshold for gifting is reducing. So it was back in the days 5 million. It got pushed up to 12.5 right now where it currently is. And now it is getting reduced down to 7 million. Who knows if it'll change again with the new administration coming in, but we're not talking about politics. That may or may not change, but as we stand, that is going to then impact a lot more people, because they cannot get the tax benefits for as big an amount as they're used to right now. So this could be a great solution for those people. Right now, we're going through a lot of boomers coming in that own a lot of stock personally. And if they liquidate that stock, they're frightened of the amount of capital gains tax that they have to pay. So one of the good solutions that we're working out right now, actually, with a client, is to donate an amount of stock to the foundation. So you're not liquidating it. You don't realize any capital gains. It just goes into the foundation. You get fair market value for that donation. So 20 years ago, when you bought the stock, you're not getting the cost basis then, but you're getting today's value. And you get a 20% write-off of that amount that you can use on your personal tax deductions as well as still owning that stock or liquidating it in the foundation or whatever you want to do in the foundation. But personally, you're going to get a 20% write-off for that. And then if you don't use it all in 1 year, you can use it over the next 5 years as well.
So let's say you've got $2 million in stock and you decide to donate $1 million in stock to your foundation. The $1 million that you write off, you get a $200,000, or that you donate to the foundation, you get a $200,000 write-off.
Correct.
Wow, that's impressive. I mean, it's these nuances that these really are strategies of the elite that most of us are not educated on. Some of these I've been aware of, but a lot of this, especially with the foundation structure, is something that's very new and I know very valuable to our audience. So before we go into the rapid fire section, I want to ask you one last question, which I think is really important for our audience to key into. As we go into 2025, we all understand the importance of getting ahead of our taxes and having the right strategy in place. Instead of everything just it becoming 10 days before it's April 5th and you go, oh my God, I got to put my taxes together. How do we as business owners structure our approach to planning for our taxes ahead of time so we don't run into that issue?
Yeah, great question. And ultimately, it's what we try to educate our clients on. Be proactive rather than reactive, i.e. set up the trust, the foundation, your structure, whatever you need sooner rather than later, because when it gets too late, you've missed the opportunity, right? So a tangible way to do that is monthly taking care of your business. So if you've got a business, use a software like financialfusion.io is what we recommend for our clients. And that gives you a snapshot. It plugs into your QuickBooks and it gives you an analysis of how your business is performing month to month, quarter to quarter, year on year.
Wow.
And if you can be on top of that on a monthly basis, you can then strategically start having those conversations because you know how you're trending. Hey, is business up? Why? Is the business down? Why? What's going on? Let me investigate. Let me look into it. Then you're going to be more on top of it. And there's another simple thing that people could do is just schedule 4 appointments a year minimum with their CPA. Every quarter, we're going to get together and we're going to have a conversation for an hour and we're going to go over some strategies. Because if you don't hold them accountable, they're never going to be knocking on your door to spend time with you because they've got thousands of clients or hundreds of clients.
Yep.
So it's really important that you take the onus of that relationship because you're only going to get out what you put in.
You know, it's really important, the relationship building with a CPA. I heard a statistic that I read, which I found fascinating, that over the last year, they only graduated about 18,000 new CPAs. That's it. Everybody has to file their taxes. Think about that. That is a very low number. So good CPAs are starting to become harder and harder to come by, especially as many of them are aging out of the business and selling their practices, as a lot of private equity funds are doing roll-ups of these CPA companies. So it is important to make sure you build a good relationship with your CPA and you deal with your tax planning ahead of time to help them, because frankly, there's just not enough people and CPAs in the industry anymore.
I totally agree. Yeah, there's 2 sides of that, right? There's 18,000 coming in, but there's a hell of a lot more retiring as well.
Oh, man. Yeah, very true.
There's a lot of boomers that have CPA firms that have been around a long, long time and looking to exit, and they are not getting any enterprise value on that business at all. The kids don't want to take over it. So you find a lot of people get disgruntled because they are very underserved in the market.
Yes, very true. KC, that was awesome. You gave our audience so much to take away. Now we're going to do the fun part, the rapid fire section, and you're going to give me quick answers on these. You ready?
Yes, sir.
Coffee or tea?
Coffee.
It is a zombie apocalypse and you have to get out of your house and protect your family. What is your weapon of choice that you're taking with you?
Machine gun.
Mine is a flamethrower. What is a book that you recommend our audience of entrepreneurs and business owners to read that can help them advance in their business?
Rich Dad, Poor Dad's one of my favorites.
I actually just read another Kiyosaki book that I'm looking at right now called Cash Flow Quadrant, which was awesome. I read it a few weeks
He's
ago.
actually got a game that he's made, the cash flow, the rat race.
Yep.
Unbelievable. Really
Have you
big recommendation.
played it? You've played it?
I have it at home, yeah.
How many people do you need to play it?
4 ideally is good.
Okay. I think I'm going to get that, and that'll be like our dinner night game because I looked at it. It's like $80. I looked at it on Amazon because I read
Especially coming up to like Thanksgiving and Christmas. It's like board
Yeah.
game season, right?
Yeah, you know what? I am going to order that. It's going to my Amazon basket after this call. So, dead or alive, if you had the opportunity to have dinner with anybody tonight, who would it be?
Elon Musk.
That's awesome. What is one thing that you disagree with in your industry right now?
The pricing models for CPAs.
What do you mean by
The way
that?
we do it is the CPA is not incentivized to save people money. Whether they save you $1 or $1 million, they're not incentivized either way. So if they were incentivized to maybe like other industries that take a percentage of whatever they save you, you'd get a better level of service.
Yeah, I agree. That's very true. Let's say you are a business owner doing 10 million in annual revenue, and I walk through the door today and hand you a $300,000 check. How would you advise that business owner to invest that $300,000 to grow their profits over the next 12 months?
Gold and crypto.
Gold and crypto. Awesome. And then last but not least, tell me 2 key people that you've had in your life that have helped you to grow to the level of success that you've realized today.
2 key people. Good one was my mentors, right? So I've got a mentor who's like a father figure to me. He's in the Billionaire Boys Club, and he just thinks so differently than anyone else I've ever met. And he pushes me to think that way too. Not that just, oh, he's so brilliant, but he's ingraining that brilliance or his way of thinking into my own mind, which is awesome. And then I'd say my mother, because she's so loving and sweet and there's not a bad bone in her body. And it's good to have that side of that person around you at all times, just rubbing off on you to give you that humility.
That's awesome. KC Chohan, please tell the audience how they can connect with you if they'd like to do so.
Yeah, Together CFO.com. You can see at the bottom of the screen there. That's the easiest way. You can reach out to us. You can do a free tax calculator on our website to see how much you're overpaying on your taxes. Takes about 35 seconds to figure it out. You can join our free school community and get that tax savings loopholes, the top 50 loopholes that everyone should be using. Or you can just drop us a message, join our newsletter, hit me up on social media. It's Together CFO pretty much on every platform. And happy to help however we can.
KC Chohan, thank you so much for joining us on 0 to 100.
Thanks for tuning in to 0 to 100 podcast. We hope you feel inspired and ready to accelerate your business. Remember, your journey to success starts with a single step. Keep learning, keep growing, and keep striving for greatness. For more resources and show notes, visit jaredguyrandolph.com. We'll see you next time.